Let's talk Chapter 8, which is about life insurance. Some of the goals for the chapter is essentially learn about the basics of life insurance and a few things, uh, determining how much you need, understanding what life insurance is, why you might need it, how much you'll need, what are some of the terminology, advantages, disadvantages, different types of life insurance policies. So we'll talk about all of those. How does this affect you? Um, insurance is there for all kinds of things, right? You can buy insurance on your life, on your home, on your vehicle, all kinds of things you can buy insurance for. And whenever you buy insurance, you're doing so to minimize risk, okay? You're trying to push risk away from you personally to the insurance company. And so think about why you would get life insurance. If you're single, it's just you have no dependents, probably don't need a lot, right? However, if you're married, you have a family, you have a mortgage, you have loans, you definitely want some life insurance. Okay, so if something happens to the primary wage earner of the family, the mom or the dad or whoever it is, and so this will provide an insurance-free benefit to the surviving beneficiaries to help them get through the replacement of income for the person that's passed on. Okay, so that's essentially what life insurance is and for. It's kind of a morbid deal, I will agree. So a lot of people don't like to talk about it. A lot of people say they don't believe in it. I worked for a life insurance company for almost 20 years of my career. So I understand it, I get that. However, I will say life insurance is very affordable, very cheap. You're crazy not to have it. Okay, so for those of you who are single, just starting a job out of college, your employer will probably offer you some life insurance. Just accept that and you're probably okay. But the second now you add somebody else to the equation, if that is a spouse and then children in the future, immediately rethink what you might need for life insurance and consider that you might need to go out and buy more life insurance than what you currently have. A lot of employers will allow you to buy above a certain number. A lot of companies will offer you one times your pay or two times your pay. So let's just say you make $50,000 a year, they might just offer you that as your life insurance benefit for, if you were to pass, you just get that for free. Um, you can buy more if you want, two times that, three times that, and so on. But just all things to consider and think about. So I'll let you guys look at that on your own, the financial facts and fantasies. The purpose of life insurance, I've already kind of mentioned that. Protect you and your family from financial consequences of losing assets or income while there's an accident, illness, or death occurs. Okay, so basically it's replacing the income of that wage earner. And it says here accident and illness also. You can buy disability insurance. So if you are disabled, either short-term, long-term, permanent, insurance can replace your income. What you normally made per month, disability insurance can make that up for you potentially. So the basic concept of insurance is risk, which I mentioned, is you are passing risk onto the insurance company. Okay, so risk is defined as uncertainty concerning a potential economic loss. Essentially, if something happens to a wage earner of a family that they cannot work anymore, or they pass away, then what? How does that family keep going on maintaining their current lifestyle? The simplest way to deal with risk is to avoid the act that creates it. However, that's not always possible, right? Just getting in your vehicle and driving to your job, there's an element of risk to that, right? There are just certain things that happen in life where you're taking a risk, and they're day-to-day things we all do every day that potentially will result in some kind of risk. So there's risk in everything that we do if you have a financial interest. So life, health, home, car, business, everything, there's risk. So living with risk, unless you live in a bubble, you have to assume risk. As I mentioned, just simply getting your vehicle and driving to your job, there is an element of risk to that, right? Unfortunately, people die in car accidents to no fault of their own. Somebody else was at fault, but you die, right? So that's just the risk that you have to undertake. Loss control is an activity that lessens severity of loss. Wearing seatbelts, clearly, right? Having certain safety features in cars. Don't drink and drive, eating a healthy diet, exercising, not smoking. Certainly there's things you can do to minimize risk of heart attack, poor health, and whatever. You can never eliminate risk completely, clearly. There's lots of things you can do to minimize risk, though. But insurance, then, again, as I mentioned, is transferring risk to the insurance company, the risk of loss. Okay, so buying life insurance doesn't mean that your drive to your job is safer. It just means if a car accident happens where you're either disabled or you die, and you have insurance to cover that, you've transferred that risk to the insurance company. Okay, but you cannot ever transfer 100% of your risk. Your actions matter. 100% they matter. So insurance companies do what they call underwriting. They're basically deciding if they want to accept you as a risk. Okay, they decide who to insure and what rate to be charged. Now, keep in mind that insurance is very heavily regulated. States regulate insurance companies, but there's always rules and regulations and parameters about how insurance companies go through that process of deciding who to insure and what rate to be charged. So there's an element that the state governments, the regulators in charge, are trying to make sure there's an element of fairness and consumer protection when it comes to these things. Companies have to guard against adverse selection when you take on a disproportionate amount of bad risks. You have to have really good risks to help pay for and offset the bad risks. A significant problem facing underwriters is how to determine the criteria for classifying people they choose to insure, basically deciding what are acceptable risks, what rate to charge, and so on. So when you go out and get life insurance, your premiums are generally based on your age, your gender, your health, and your occupation. Clearly, some occupations have higher elements of risk to them than others do. Benefits of life insurance: financial protection for your dependents. That's the whole purpose to get it. Protection from liability. So if a wage earner passes and you now have some benefit for life insurance, you can use that to pay off bills. You don't have to worry about paying a mortgage anymore. That's taken care of through life insurance. The proceeds are not taxable, which is fantastic. Life insurance can also be a savings vehicle. Although not the best savings vehicle, it still can be used for an element of savings. So do you need life insurance? The answer is yes, if you have dependents who count on your financial support. So the second you have a child, you better make sure you've got plenty of life insurance. And if you have debt such as a home mortgage. Okay, so if you have a home mortgage, even if you're single, it's probably worth having enough life insurance that if you pass, that your home can be paid off, so that whoever has to sell your estate doesn't have to worry about that. No if you do not have dependency support and you're a child. Maybe yes for funeral costs and other end-of-life expenses. Okay, so it's always probably worth having a little bit of life insurance, even if it's just you. And typically, as I said, most employers provide some life insurance at a very low cost or for free. A lot of employers will provide your salary or 2 times or 3 times your salary for free, just as a benefit offered to you. So just take that and accept that. If you don't need life insurance, at least take that much. Name your parents or siblings or somebody in your life as a beneficiary if you don't have dependents. How much do you need? Again, there's lots of ways to figure that out, and of course a good agent will help you figure that out too. It says multiply your annual earnings by an arbitrary number. Rule of thumb is somewhere between 5 to 10 times your take-home pay. You can estimate needs and examine available resources. Again, an agent, you can do a Google search for life insurance amounts and needs, and you can definitely find some online resources to help you with that too. So, but part of that then is worksheet 8.1, which you will use for the homework for this chapter, which I have open right here. And this is a life insurance needs analysis worksheet. That's primarily what the homework for Chapter 8 is about, is computing what you need for life insurance, and then some of the pricing also that you would go through and calculate to figure out the cost of insurance. But that's for Chapter 8. You'll be using this worksheet to figure that out. So basically what you're doing is you're assessing your economic needs, the income you would need to maintain your current lifestyle, extra expenses if the income producer dies. Will there be extra costs now the family has to incur? Special needs of dependents, and debt liquidation, and liquidity of your current assets. Step 2 is determining the financial resources available after your death. How much savings or investments do you currently have? What will your Social Security benefits be? Other life insurance or other resources. And then step 3 is just to figure out then how much insurance you need to protect your family and take care of the lifestyle that you want to maintain, take care of things like a mortgage or car payments or student debt or anything like that. All things to keep in mind. And the nice thing, of course, the best thing about life insurance too is it's not taxed. So you get every dollar you get in a life insurance benefit is 100% yours to keep without having to worry about taking any tax out of it. So term life insurance, there's really two types of life insurance: term and whole life. And term is very, very affordable, extremely affordable. I carry two $500,000 policies on me, and a $250,000 policy. Actually, I have three policies when I think about it, for a total of $1,250,000, and it costs me $100 a month, like 101 and change per month. And the reason I have so much is I'm the primary wage earner of my family, so that's why we have a lot on me. I have about 500,000 on my wife, and she is not the primary wage earner by any means. Um, but that's just how we chose to do that. And actually, that 101 includes her $500,000 policy. So that's $1,750,000 that I'm paying $100 a month for two people, and that's the benefit that I get if if I were to pass or she were to pass. So it's a set amount of benefit for a certain period of time. So when my youngest son was born, we got a couple of 30-year life insurance, 30-year term policies, and basically what that meant was for that 30 years, as long as I make the payments, my rate is locked in. Okay, and so again, I mentioned earlier that the younger you are, the cheaper insurance is. Okay, so the younger you are, the healthier you typically are, the cheaper the insurance is. So the benefit is paid if you die within that term period and you are current with your premium payments. It's a very simple policy, a very affordable policy. You have straight term, the coverage is the same, or decreasing term where the premiums remain the same but the coverage decreases. I just went with the straight term. This is a very easy policy to do. It's a very easy policy to issue for the company, very easy policy to get. Renewability of insurance. Now, after that 30 years, you can buy insurance as guaranteed renewable, that no matter what your health condition is after 30 years, the company says, because whatever it could be, term period could be 5 years, 10 years, whatever you want. I went with 30 years because that at that point, that just what made sense for my family. However, if you buy guaranteed renewable term, then you are guaranteed that the company will issue you another term policy. Of course, they'll price it based on your current age and health conditions, but they will guarantee you an issue of a policy. Convertibility means converting to whole life without evidence of insurability. We'll talk about what whole life is here in a moment. So I mentioned that term insurance is based on your age, your gender, your health. Also, if you're a smoker or a non-smoker comes into play. And so this just kind of shows you for a $100,000 policy what some of the rates are for those different policies based on some of the criteria that go into pricing the policy. So term insurance advantages, a very economical way for young families to purchase large amounts of life insurance, and provides a need for needs that disappear over time. Because clearly, once your kids are established on their own, once your home is paid for, your need for life insurance goes down dramatically, right? So you need it when you're younger and you've got a younger family, you've got a home mortgage and other things to worry about and pay for. But once your dependents are on their own and they're all established, your debts are low, your need for life insurance goes down dramatically. Disadvantages, of course, premiums become costly as you get older, and term insurance does not build cash value, which really isn't necessarily a big deal. The next is whole life. So really there's the two main types of life insurance are term and whole life. Whole life is the reason it's called whole life, it's providing a benefit during the individual's entire life. It's called permanent insurance, so it doesn't expire like term does. And as long as you're making the payments, you are covered. It provides a cash value, so part of your premium payment includes a savings component where you've got some of your money goes into essentially a savings account that builds value over the life of your policy with interest. Now, the reason it's not necessarily the best insurance, is not necessarily the best savings vehicle, because the rates you receive aren't necessarily that great, and quite often insurance companies will charge you a lot of expenses and fees for the right to have that whole life policy. Now, quite often insurance companies also allow you to surrender the policy or do a policy loan. And so with a surrender, the longer the policy has been in effect, the charge for that surrender goes down. There might not be a surrender charge after 10 years, for example. So basically, whatever the cash value of your policy is, you'd get all of that back. This just illustrates then cash value over death protection. And quite often what happens then, as your cash value builds, your death protection may go down, and you can just see with the age to the right, and then the value up that goes up. So as that policy builds value, a lot of what you get back is just simply what you've been building up as savings. You get that back. So if you buy a $200,000 whole life policy and you make payments, they're just guaranteed to say when you die you'll get $200,000. Well, that might be a part of that might be what's been just accumulating as savings, but you just get $200,000 no matter what. So the deeper you get into the policy, the older you get, you're really just getting your money back, and not necessarily the death benefit from the insurance company. You're essentially just getting your money back. So there's good and bad to it. My suggestion for almost everybody would be go out and buy term life insurance. It's very affordable. It's very easy to get. There are several very reputable companies that sell it. It's a very easy thing to do. Some other types of whole life policies: continuous premium, straight life, level premiums paid until death or policy cancellation, limited payment, or level premiums paid for a specified number of years, insurance in force until death, or single premium where you just make one payment and now you are now covered for a very long period of time. There's lots of ways to do it, but these are all examples potentially of whole life policies. Advantages: the savings component. You can borrow against that cash value. The premiums remain constant, and the cash value accumulates tax-free until redeemed. Disadvantages to whole life: you can see here less death protection for young people, low return on your savings, tax penalties potentially for early withdrawal, and outstanding loans subtracted from the face value upon death. Okay, so you might not be getting that much benefit from the company the older you are with one of these. There's also something called universal life insurance, which actually isn't a bad deal. It's kind of almost a hybrid between term and whole life. Permanent value still permanent insurance. The cash value insurance that combines term insurance with tax sheltered savings, provides death protection plus savings. Premiums are unbundled into two accounts. Savings grow at current interest versus guaranteed minimum, and provides flexibility of premiums paid and death benefits. So it offers some flexibility and a little bit of the benefits of term and whole life. So basically the interest that you earn on this will be either a minimum number that's guaranteed, or it could be higher than that based on certain economic factors happening. Just some examples then of what you would pay for universal life policies. Another example is called variable universal life, or called VUL would be one way to call it, but variable life provides death protection plus savings for cash value. The cash value can be invested in mutual funds for greater possible return. The returns are not guaranteed, and the actual death benefit can vary. So what's different between universal life and variable universal life is that with variable universal life, the policyholder chooses and decides where the money is invested. So you get to choose from a portfolio of mutual funds where the money that you put into the policy is invested and taken care of. So that's why there's no guaranteed minimum. The returns can vary because it's all based on how the mutual funds that you invested in performed. Other types of insurance, so variable insurance, group insurance. Group insurance is typically offered through your employer. As I mentioned before, a lot of employers will offer group insurance with a set number that they'll give you for either for free or for a very low cost. But if you want to choose to increase that number, you can pay extra, or you can buy extra insurance for a spouse or child also. There's also what they call credit insurance or mortgage insurance that will cover a specific loan that you take out. So if you were to die or become disabled, these policies may then make up your payments while you're either disabled, or if you pass, pay off whatever loan balance is due. Um, Typically, they're very expensive, and the benefit, of course, decreases as the principal of these loans are paid down. But typically, these are not good deals. You're better off just having enough regular life insurance to cover these as opposed to taking on one of these. So I would typically not recommend doing these. So when it comes to buying life insurance, shop around, 100% shop around. Insurance is really treated like a commodity anymore. There's hundreds of very viable and reputable insurance companies that are available to issue you a policy. Select a large, highly rated, financially secure company, and then choose a reputable agent. And I will just again offer, I know several people who sell life insurance, and so if you are in the market to buy life insurance and just need a name of some people to help with that, let me know. There's several USF grads that I know that sell life insurance and would definitely set you straight and give you great advice and sell you a product that you need, not just what they want to sell you, but what you really need. So just let me know if you're in that situation. I'd gladly give you some names. And of course, always ask your folks, ask family members, just get advice from people you know and trust also. That's always important too. But if you just need some help finding a name, please let me know. And this is just a good summary of the advantages and disadvantages of the different types of insurance. So this is just a good summary to kind of have in front of you before you do the test or quiz for the chapter. And then what type of insurance is for you. Typically, I'm going to tell you probably term insurance makes the most sense. Um, you know, whole life is a way to save some money. The strategy that probably makes the most sense is, if you're going out and buy a policy, find out what it would cost you to pay for a term versus whole life, and then buy the term, and what the difference extra is, invest that. And we'll get to some chapters later on where we'll talk about how to invest, and just take that extra and invest that somehow. That'd be my advice. But typically, you're going to find that term would be give you the best deal. Just some terminology with life insurance. You'll have to know as you fill out a life insurance application. Of course, an agent can help you with these. Is the beneficiary, the settlement options, how will benefits be paid, if it's lump sum, interest only, over a fixed period. You can have lots of options. You can just accept the whole payment up front. An insurance company will put the money into an account for you that earns interest, and you just take it out as you want to. Can you take out a policy loan? What are the premium payment terms and grace periods? Non-forfeiture options. If you pay it up in advance, things like that. Policy reinstatement. If you don't make payments for a while, can you go back and reinstate it? Those are all just things to consider and think about. Other policy features: indemnity, suicide, exclusions, participation, living benefits, guaranteed purchase. Just the book lists all those and gives a little bit of explanation for all of them, so just make sure you take a look at those. And then An agent will give you, or if you buy insurance online, usually a website will produce these for you. And what they are policy illustrations that show you if you make your payments and you earn a certain amount of interest on your insurance, here's what you're going to get. And they typically are very rosy. They typically don't turn out quite that way, but agents will give you those and kind of help you explain some stuff. But just kind of be leery of those illustrations. Um, just they give you the best case. Ask them what will this look like under the worst case or the average case scenario in terms of the return that you get and so on. But just be wary of those. But they're informational, but just kind of take them with a grain of salt.